topic of section 45(4) and section 9B of the Income Tax Act 1961, and obviously businesses are getting operated. We are just near to completing 100 years of very recently in our office we faced an assessment. I mean, in the appeal proceedings, now we are in the appeal. A very simple but for AY 24-25, I was told that many of these cases of the partners were being picked up for 143(3)(s). Which provides an exemption, has become now a question of an interpretation, and the assessing officers have passed the assessment is about interpreting the law, and he interprets the exemption provision provided under section 10(2) in a way that he says that, look, you read partnership form, and therefore in that year of assessment the partnership form, for example, had earned the profits of 100 rupees. Now that partnership form had some brought forward law, the total income itself has been defined in section 2, which says that income computed in accordance with the provisions of the act will be considered to be a total income, and therefore your total income is nil because you go in the computation of income, not in the book of account. And therefore he says that that share of that 50 rupees which is credited in your capital account I can't grant you an exemption that after lot of decades have gone, we are So we had some discussion in the Supreme Court decisions and the High Court decision is that it cannot be considered as a transfer. When something is given by a partnership firm to a partner, it cannot be called that there is a transfer. Partner has received the capital asset or a stock interest. So that year of transfer would coincide with the year of receipt of that capital asset or a stock in trade by the partner. So having provided for so if there is a deemed transfer of capital asset, it will go into capital gains. If there is a deemed transfer of stock in trade, this will go into the business income, and this income will be computed in accordance with the provisions of which they were received by the partner, that would be considered as the deemed full value of consideration. So because there is a transaction between a partnership firm and a partner, and maybe possible that a consideration is nothing but a new avatar of the erstwhile provision of section 45(4), which was dealing with the capital gain arising from transfer of a capital asset by the partnership firm to the partner on of a stock. Section 45(4) was not providing for a deeming fiction of a deemed transfer, whereas 9B provides this will be considered to be a deemed transfer. So we had some interpretation. Now this word otherwise was the subject matter of controversy. If you remember, we had Bombay High Court decision in the case of Anil Naik, and there the question arose before the Bombay High Court that such an asset given upon retirement or reconstitution of the firm, and reconstitution has been defined that all three events would be considered as an event of reconstitution. So there is an absolute clarity provided, and there is one more and last change. If there is only one partner who is receiving something from a partnership firm, it cannot be said that there is a distribution. What do we mean by, what is is the simple meaning of the word distribution? That I have more than means that you are distributing your assets or whatever you had to more than one person. Therefore, you need to have more than one person on the other side in order to trigger the provisions of section or 12 provision of section. Provides for non-abstain clause notwithstanding. So yes, in my remarks in the beginning, I said that there is no difference whatsoever between the old provision and new provision, but that is subject to one exception. Provides that notwithstanding that general charging provision of capital gain under 45(1), this particular provision will apply. And when this provision of section 4 will apply, what is the trigger point? The trigger point more or less receipt of capital asset and stock in trade, and 45(4) is referring to receipt of money or capital asset. It doesn't refer to stock in trade. 9b doesn't refer to receipt of money. 9b refers to it will be chargeable to tax as income of that partnership firm. So it says that basically it is a gain of a partner, but that gain of the partner is not taxable in the ends of the partner. Is say it is the year in which this assets or money is being received by the partner from the partnership firm. And how to compute the income? We have been given a formula. It is A is equal to B plus C minus D. Money or capital asset. So take sum total of money received and fair market value of the capital received, and from this sum total you reduce D. And what is D? D is nothing but a capital balance of that under the capital gain. So that particular explanation is provided, and further we have been told that this new provisions of section 45(4) is targeting to tax the SSC and not to provide the under the capital gain. So how do we reconcile this 9B and 45(4) friends? It is very simple. That 9B, just to reconcile before we move on to the case studies. So 9B thing else. Stock in trade is covered by 9B, but it is not covered by 45(4). Dissolution is covered by 9B, but not covered by 45(4). So we have only one common situation, and that common situation been provided in section 45(4), which says that under such circumstances, the taxation under both these provisions will apply independently, and you cannot argue that I will apply either of these two. Number 3, which has been inserted in section 48. So 48 is a computational provision for the purpose of capital gain, and this computation, this clause 3 doesn't deal with the computation of capital gains. That whether it will be resulting in double taxation, to some extent that question gets answered over here, to some extent, and not fully. So before we deal with that particular clause, let us understand the basic scheme. But if the gain is unrealized, I am holding the asset. The market value of that asset has gone up, but I have not yet sold that asset. Whether that unrealized gain in the value of, because unrealized gain is not required to be taxed in the hands of the partnership firm under any circumstances. But because of reconstitution, you and me were partnership firm was holding an asset, and there is an appreciation in the part of the settlement for an reconstitution, that outgoing partner, although firm has not realized that appreciation in the market value of that asset, but that outgoing partner indirectly realizes his share to that extent that gain is required to be taxed. And therefore, this gain is taxed under the provision provisions of section 45(4), that is the idea, and therefore we have a corresponding clause 3 inserted in section 48. Of that amount already taxed, while we compute the realized gain, there should not be a double taxation. If you are not clear with that explanation which I provided, let me take one very simple example. There were two market value of that asset which was originally acquired from out of the 20 rupees of capital. Market value of that asset has reached 200. So there is an unrealized gain of 180 which cannot be taxed otherwise. Light of this new provision. So capital gain of 90. Partner A is paid 100 rupees. This capital was 10 rupees. That difference of 90. B plus C minus D. So that 90 rupees is getting taxed in the hands of so otherwise my gain was 300 minus 10 rupees original cost. Right, 280 rupees was my gain otherwise. But out of 280 rupees, 90 rupees was already taxed. Reduce over and above this, as per clause 3 of 48, that 90 rupees which was already taxed will also be attributed to this asset, and that will also be deducted, and therefore my net capital gain in future will be 109. Five, sorry, 8AA5 and 8AB. First, we will be dealing with this rule 8AB. This rule 8AB is supporting my 48(3) deduction, which I just earlier. We have three sub-rule, 2, 3 and 4. 2 provides for attribution, 3 and 4 prohibits attribution. So sub-rule 2 is very simple. It says that what you do is that you obtain a allocated in that proportion to all of these capital assets which are being held by the partnership. So just to summarize, I can give you a simple example. Since we might be running out of time, so I'll appreciation in the market value in that same ratio. So here the appreciation was 1:2. X के अंदर appreciation was one time and Y के अंदर the appreciation was twice. And therefore this 90 rupees in not 45.4 capital gain, whatever amount is taxed in your hands is taxed. You cannot get any benefit of step cost in a case where it is not attributable to any capital asset. Any of the benefit. And suppose 4, it says that, and I've just given one simple example to understand that here the outgoing partner was paid settlement amount on account of appreciation in the value which says that since this is not related to any appreciation in capital asset, you cannot get the benefit of step cost under 48.3. And the sub 4 says that it says that now this capital asset has already been given to the partner. You are not continuing this capital asset anymore, and therefore here also you will not be getting any benefit of step cost. The example with respect to this is also provided in my presentation. Like clause 3 of section 48, nevertheless circular says you will continue to get benefit when you compute the capital gain arising from a depreciable asset. However, it says that you cannot claim depreciation by enhancing section 9b, which deals with a case where there is an asset, capital asset of the partnership firm, there is a retirement of one of the partner from the partnership firm, and it is that capital asset which has been given to a partner. Becoming applicable, and therefore is this resulting in a double taxation? The answer is yes, but we have some benefits which have been provided in the circular. So instead of dealing with as to what are the benefits, let me give you a simple example. It says that what and therefore to that extent you can enhance that figure of D. The formula for capital gain under 45 for B plus C minus D, right? So D is nothing but the capital balance of the outgoing partner. Where 50-50 is one of the partner is retiring, Mr. A is retiring, and a firm was holding several assets. One of them was capital asset X, and that capital asset X transferred to that retiring 'Become taxable in the hands of partnership firm under 90 after indexation, and before it says that you compute capital gain, arrive at the taxable tax amount, and post tax book profits. You 45.4, you will get a deduction of this 30 rupees which you have added to the capital account by virtue of that formula, because this amount will get captured in the amount of D, the capital balance of that partner at the time of reconstitution. So this is determined whether it is short term or long term. But when it comes to 45.4, we have great difficulties, because if you remember, 45.4 says that B plus C minus D is capital gain. Now, what is B? Value of money received by outgoing. Because the rate of tax is going to be different, and there might be some other provisions of the act which might apply depending upon whether your capital gain is a short-term capital gain or a long-term capital gain. For example, you have some losses to set off, and some capital asset or a depreciable asset sitting inside the block, or goodwill, generated goodwill, etc. In that case, that 45.4 capital gain would be considered short term. If it is attributable to a long term market value already held by the partnership firm in the background, and therefore you have to look at that this particular excess amount paid to the partner is attributable to the appreciation in which asset, whether in the ends of the firm. In that case, this gain will also be treated as long term. This is how we have to determine uh, the character of that particular capital gain, and for that we have to file one particular form, which is form as I clarified earlier, so I have about 45 minutes. I'm going to take only 2 yes, sir. We will pay, none of this provision will apply. Yes. With this particular benefit on account of the reconstitution, there might be a possibility to then extend the provision and say that although you have not received in reality, but this needs to be considered as a direct receipt on account of reconstitution. That is something which needs to so my case studies are simple. Okay, so one partner, Mr. A, retiring in year number 1. So let's call as in my case study I have involved 3 years, which is he was to be paid 5 crores in full and final settlement of his retirement against capital balance of 2 crores. So simply speaking, there was a surplus of 3 crores which a retiring partner was entitled to lump sum settlement that he paid 5 crores. I will relinquish all my rights over the partnership firm and the assets held by the partnership firm. Now, out of this 5 crores, it was only an amount of 2 crore which was paid in year 1. His capital form carrying 10 percentage interest. Right? In this 3 crores, thereafter, later on, in subsequent year, year number 2, he was first paid interest of 30 lakhs on that. Situation which we can assume that that erstwhile partnership firm was already converted into a company, right? Or alternatively, or in addition to this, that is transaction under section 9B or 45(4), right? So this is a very common question which we receive, is that a upon there was a partnership form and there is a death of a partner, common situation, along with several other questions. My case study is otherwise very simple. Year 1 retirement, 2 crore capital balance, paid capital balance becoming 0. Another 3 crore was to be paid. It was parked as a loan, carrying 10% interest. Right? All of you clear with the facts of this case study. The first point here is there was a simple question. Let's answer those simple questions first. So the provisions of section 9B will not you concentrate only on 45, right? So let's forget about 9B as far as case studies 1 is concerned. We will come back to 9B in case study 2, provided I am left with some time to deal with case study. Against capital balance of 2 crores, you will be paid 5 crores. Now, section 44 says that any partner receiving money as per formula B plus C minus D, B is a that 45.4 provides as well as 9B provides, but it is the year in which that money or capital asset is received by the partner, it is that year in which this amount shall be chargeable. Concern what I received is 2 crores. What is my capital balance? 2 crores. 2 crores minus 2 crores 0. Nothing is taxable in year 1. And it will be taxable only in the year in which I receive that particular amount. Of legal affairs or that conversion of company into form into company, etc. Right. So counter that particular argument is that then payable upon retirement to his account. I don't think so. The accounting principles will not permit us to do that, and therefore there would obviously entries which will be passed in the book of accounts upon every retirement, but in spite of we have first decision dealing with this is Raghav Reddy's case, Supreme Court decision. And Raghav Reddy's case, Supreme Court was dealing with a position where a non-resident could have been taxed only if the income is received in the question was, can it be said that the person upon crediting commission to his account, can it be said that crediting something to his account is equivalent to a receipt of that amount, and therefore it is resulting into a taxable income in India? That was the question. To the agreement was bound under the agreement that he need to utilize the amount in accordance with the instruction of that particular person whose account this amount was credited, and therefore it is not mere credit which is at disposal of the depositor, and depositor can utilize that particular amount whenever he wants and the manner in which he wants. And for Supreme Court said that here under such circumstances this should and therefore if we apply the principles which have been laid down by Supreme Court and we come back to our case study, some of the points which we need to observe is that this amount which was payable to the retiring partner, 3 crore, was agreed that such loan was to be repaid on demand. So whenever that person is demanding, that loan was repaid. So considering all these facts, considering the entries which will be passed in the books of accounts, and considering on an interest with that erstwhile partnership form, and therefore there is a high probability that it may be considered as a constructive receipt by that retiring partner, and therefore and we can understand the arguments which may be available on both the sides of a particular question which I am showing. Okay, and therefore another aspect which is required to be considered is that we have the provisions of section 4. Converted into a loan that will not be treated as a payment for the purpose of section 43, and therefore otherwise in the absence of that explanation calculation inserted, it was possible to say that when capital balance payable, the settlement amount payable to the retiring partner is being converted into a loan, this will be treated as a payment of that particular amount, a constructive payment, a constructive receipt of that amount by the retiring partner. The purpose of making payment to the retiring partner, and therefore it is out of force. This amount was being parked in the loan account, and it was agreed that as and when the concerned liquidity would be available with the partners, right? Because the Supreme Court decision which I dealt with in Raghav Reddy and the Standard Triumph Motor, the Supreme Court observed that when the amount is kept at the disposal of that person, although that it is, since the firm is out of liquidity, the amount has not been paid immediately, and it will be paid over installment as and when this liquidity would be available with the partnership firm out of the further business to be done. Therefore, since the amount is not taxing this particular amount. Coming to the next question which is arising from this is that if you have observed one of the point, the first bullet point on this particular slide, that he was paid some interest. Second, 45(4) provides for deeming fixing that this income shall be chargeable to tax in the year in which this is received, and further it is taxable in the hands of the partnership firm and not the partner. Liability of a partnership firm, you are saying? Nothing is payable, nothing is taxable. Yes. By a partner. If you apply 45(4), interest is otherwise taxable under the income from other sources. But if you apply 45(4), this will get taxed under the year capital gains. Because interest was received by partner person. Therefore, this is also nothing but in connection with the reconstitution. And therefore, I will also add this to 5 crores plus 30 lakhs, 5 crore 30 lakhs, and I'll tax you on the whole amount under section 44 in the ends of the partnership form. In connection with the decision which he took to park the amount receivable by him as a loan. And therefore, probably the correct point of view here is that we need to look at the first relation claiming this interest amount as an expenditure in its use. And settlement amount paid to retiring partner otherwise generally cannot be claimed as a deductible expenditure or revenue expenditure, and therefore having claimed this interest expenditure as a revenue expenditure, that we succeed in arguing that in year 1 entire 5 crore is not taxable. Let's assume that for a moment, then only we will be able to deal with the other issues which are involved in the case study. If we conclude everything is taxable in year 1, you can't argue that it is not taxable forever. We need to look at year of receipt, and therefore if you succeed that this 3 crore was not received in year 1, at least it is received in year 3, and therefore now you need to pay the tax in year 3. But the twist in the story is applicable when a specified person has received from a specified entity, and specified entity is defined as partnership firm, AOP, BOI, but not including a company. And interpret this provision strictly, the provisions are failing, but there are some issues on such a strict interpretation of the law. And what are those issues here is that here there is a case of a succession of a business by a partnership firm. Taxable in the hands of predecessor is now taxable in the hands of the successor. I'll give you simple two decisions. The first decision is of a Supreme Court in the case of T. Bhadresh. This was a case where there was probably an amalgam So, for example, amalgamating company had sold some goods. The amount was recoverable from the debtor. Amount could not be recovered, but the debtor was written off as bad debt by the new company, amalgamated company post amalgamation. The department this deduction on the ground that you are a new company, you never credited this particular amount in your books as an income. It was some other erstwhile entity which credited this amount of debt as an income. Therefore, you are not satisfied with only on this particular account that the predecessor entity had considered this as income and this was not considered as an income by you. We have one more decision in the 41.4 which talks about recovery of bad debts, and this decision is from Madras High Court in the case of Sundaram. Had availed some deductions and his successor, which is a new assessor altogether, is receiving some benefits. The provisions are specifically incorporating this particular income under section 4 of 41. But when you look at subsection 4 of 41, it doesn't talk about specifically the successor is also taxable for recovery of bad debt. And for one particular SSC argued on non-taxability of recovery of bad debt. Limited held that although there was no specific provision like subsection 1 dealing with predecessor and successor, but here since the successor is put into the shoes of the predecessor, the deduction of debt claimed by predecessor to you so that you can probably take an informed decision with respect to this question if at all we are facing. But the interesting and the last question with respect to this case study 1, we have second speaker already arrived. So the interesting last question of case study 1 is there was a firm, there was a conversion of firm into a company, and now we are dealing with a question where the recipient got changed. Mr. A was to receive that amount, but unfortunately he died, and therefore his legal heirs are now receiving this amount, whether 45 considered as a specified person. The legal heir cannot be considered as a person who is a partner in the partnership firm. The person who was a partner, Mr. A, already died. He didn't receive this amount. The amount received by legal heir. So Mr. A there is a change in the parentry, because with respect to the taxability of the death of an SSC, we have some specific provisions under the Act, namely Section 159. So the question is that can the assessing officer invoke can trigger the SSC is an individual and there is a death of that individual SSC. And here the taxable entity is a partnership firm which continues to exist, and for Section 159 cannot be made applicable. Cannot be considered. There is an employer-employee relationship between that employer paying and the legal heirs receiving. In the absence of employer-employee relationship, this amount cannot be brought to tax in the hands of legal heirs. And therefore, applying the same argument over here, it is we are dealing with subsection 445. Immediately next subsection 5 of 45. It also deals with chargeability of capital gain in case of compulsory acquisition of any capital asset and compensation received. Capital gain under subsection 5 of 45, and therefore it implies that you need a specific provision under the Act to tax the legal heir when he receives this. Otherwise, there was no need of that specific explanation in about the manner of settlement. We discussed that it was a lump sum settlement which was being done. Now, when I talk about the benefit of step-up cost in order to avoid double taxes, and I told you that if this 45(4) capital gain which is taxable, if this is partnership fund, is because the manner of making the settlement was a lump sum. No valuation of the assets was done. It was not backed up by any valuation exercise, etc. It was a lump sum settlement which was done. So the idea is to draw report of all the assets benefits of the partnership form. And once you arrive your settlement amount on the basis of such valuation of the assets, then only you will be able to get the benefit of step-up cost. If you have done this in a lump sum way, lump sum manner, you will have difficulty. Case to get benefit of the step-up cost. In the last case study, we have 10 more minutes. Yeah. Yes, sir. Only that much will be but you won't get any benefit as a deduction. That will still be considered as part of revaluation. To the extent you are receiving something in the capacity of legal here, yes, this argument which we discussed will prevail. Yes. No, but it is resulting into yes, sir. Sorry. Yes. But you are also a partner. By another form. There is a change in the SSC altogether. Correct. But if you read section 178, there is a definition of succession of one form by another. The 7 more minutes. Case study 2 is something which is very interesting. So I just summarize quickly, and those issues I deal with those issues as quick as possible. So we have partnership form, or rather LLP, engaged into a real estate business. Partner out of 3 partners, Mr. A is retiring. He was having capital balance of 5 crores. It was decided that he will be paid 3 crores, lesser than capital balance. In addition to this, it was decided that he will be allotted 2 units. So retiring partner 5 crores capital balance. Against 5 crore, he was just paid 3 crores money, as well as 2 units out of the real estate project carried on by a partnership firm were allotted, the value of which was 4 crore. Completion method and project was not yet fully completed in this year of retirement. How do you deal with percentage of completion method and entire project was not completed in this year of retirement? How do you deal with this particular? So before we go to 90, let's continue to discuss 45.4 and conclude 45.4 to the extent possible, as quick as possible. Whether 45.4 will trigger is a question. My capital balance that 45.4 talks about receipt of money or capital asset. B is the value of money, C is the value of capital asset. And here the partners firm is allotting 2 units from the real estate project which first view probably is that you cannot include the value of stock in trade is because 45.4 charging same contention, same arguments which we discussed. 45.4 is a charging provision, strictly is required to be interpreted, creating a dimming. Bill was converted into act, these words other assets were substituted by capital asset. So probably this was a conscious decision of the lawmaker to say that we want to apply 45.4 only when the partner of capital asset upon reconstitution. Therefore, there are clear indications under the law to say that when a partnership firm is handing over the stock in trade to the retiring partner, 45.4 is not becoming applicable. This is one side of the story. Received by me, whether that asset is a capital asset or stock in trade, do I need to see from the point of view of a partnership firm, or do I need to see from the point of view of the partner who is the recipient? The character of the asset, whether it is a capital asset or stock in trade, do you see this from the point of view of the recipient, or do you see this from the point of view of the giver? or a stock in trade in my hand. This is one of the point of view of which may be possibly may be argued by the revenue from the other hand. I am not concluding on this, but there is a problem with respect to this particular interpretation. Then there is a further twist, further complication. Applicable only upon introduction of a capital asset by partner in the partnership firm. Therefore, view was taken that this will not be taxable under 45(3). The tribunal held then that when you introduce your stock in the books of the partnership firm is now not intending to sell these two units in the market. It is appropriating these two units for the settlement inter say the partners, and therefore at that point of time it is first resulting into a conversion of we are going to have lot many difficulties to answer this particular question, but fairly according to me there are, as I mentioned, there are enough indicators under the law to say that the stock in trade received is not getting covered under the provisions of section 45(4). This is taxable under 45(4). What will be the nature of capital gain? Let's assume that 7 crore minus 3 crore, sorry, whatever is the capital balance, my capital balance is 5 crore, total amount received is 7 crore. Assuming that stock in 45(4), if this is attributable to short-term capital asset, block assets, or goodwill, then that will be short-term. If it is attributable to long-term assets of the firm, then this is long-term. Now here this is 44. Assume for a moment that partner is paid full amount of 7 crore in money form, no allocation of any units, then 44 certainly is applicable. Now how are you going to characterize this capital gain in the question? Because is failing, and therefore this is not taxable at all as my income now, in view of that Supreme Court decision in the case of BC Srinivas Sethi. We have been told, my student days I was told that Supreme Court has said that chargeability is one thing, in computation of 4 is the retiring person was a partner in the partnership firm, he was a partner for more than 2 years, therefore you will classify this as long term. If he was a partner for less than 2 years, you will classify this as short term. Answer probably is no, is because 45.4 is basically trying therefore, how do you deal with this question is probably I am leaving it with you because we are running out of time. And the last question which I'll be leaving with you is that if at all you have taxed that difference, you subsequently sell that asset. But unfortunately, that clause 3 is under section 48. 48 deals with the computation of capital gain. It doesn't deal with computation of business income. And therefore, in this case of a real estate firm, whether I'll be able to, no supporting provision to deal with this case for computing business income, I should be getting a deduction because there is a basic principle that same income cannot be taxed twice. The answer to that question probably is also no, because you need an express provision to get a deduction. With 9B 45.4, I had very limited time to deal with the questions. Thank you, friends. I am thankful to all of you once again for giving me this opportunity. If you have any questions, so 9
Yeah, we'll get yeah. Thank you, Bhadresh bhai, for the detailed explanation and getting us through the provisions of erstwhile section of 45.4 and 9B under the new act. And one announcement, we have kept
true measure of a great speaker lies not only in what is said, but in what the audience carries home. So, from the section of Bhadresh, it is very clear that we are